Hey, my name is James Shepard. This is going to be a very different kind of video episode here. Much different than anything I've ever done in the past. As you can see, we are literally looking at a blank spreadsheet. And so you're probably thinking that this episode is going to be incredibly boring. And if you don't like business, you are correct. But for those of you that actually do enjoy business and understanding financial projections and things like that, I think you'll actually really like it. I do consulting, and something I've been doing a lot more of the last couple years as our focus has shifted more to our technology company. And so a lot of times an ISO or processor will hire me to come out for a day or two or do a remote session and just kind of talk about strategy. And a big part of that is kind of understanding how a processor really works and what the financial projections are behind that. And so as a result of that, I've had a lot of requests from people who were kind of trying to get a deeper understanding of the industry. Sometimes maybe you're a sales rep and you've been doing, 15 deals a month, 10 deals a month for a while. You've got a book of business. You're thinking about leveraging that book of business and then hiring sub-agents. Or maybe you've got a smaller office and you're thinking about growing to the next level, or maybe you're already a larger company and looking to find areas of growth that are going to be a good return on investment for your capital. And so what I want to do today was literally just take a few minutes of your time and just talk to you about how this industry really works. What are the financial assumptions that are the foundation that kind of underline the industry, and show you how I would create a projection. This is going to be an extremely simplified projection, but I'm just going to show you kind of generally how I would go about making a projection for an ISO or processor. If you'd like more information on this, of course, you can comment below, or you can shoot me an email, and I'd be glad to set up a consulting session with you to talk more in depth about it. So let's start off by doing a couple things. We're going to leave these first two columns blank. This is going to be kind of our description column over here, and so we'll put month. And then this is second column is going to be where we put our assumptions, which I'll talk more about in a second. And instead of me actually doing dates, we're just going to say this is month 1, and this is month 2. And then let's just drag this out to maybe here. We'll go a little further. Let's go out to, there we go, to 48 months. So we have a 48-month projection here. Then we're going to go here. Now the first number that's going to matter is going to be your monthly submissions. Now, again, this is going to be an extremely, simplified version here. And so we're actually just going to put in a little box here, and let's say that you're planning to do 30 deals a month. And then what I'm going to do is I'm just going to make a formula that says that it equals, that cell right there. And that way I can basically just copy this all the way out and say that we're going to get 30 deals a month forever with no growth. And of course, obviously, if you're doing this projection legitimately, you're going to want to, I would actually have this go up and down based on the time of year, based on the growth, et cetera, et cetera. But this way we can change it to, 20, or we can change it to 40, and, that'll change all of them. Now, the part that should go above this in these sections right up here, this is where you want to have stuff like, recruits. So if you're going to do recruiting, you'd have, your number of recruits here, and then you'd have something like, okay, we're going to recruit, 5 reps a month, something along those lines. And then you'd also have the attrition of the reps. So I'll show you real quick, and then I'm not going to actually do this for this projection, but I just wanted to talk about it for a second. So basically you have recruits, then you have rep attrition, then you have total reps, sale or submissions per rep. And again, I'm just kind of doing this by memory here, so bear with me. But the general idea here is, you put down, okay, we're going to recruit, let's say 5 reps a month. And we can actually just drag that all the way out. So you say, okay, we're going to recruit 5 reps a month. Then you have some kind of attrition formula, which a lot of this is going to depend on how you're recruiting the reps. Are you providing them with leads? Are these experienced reps? Are they inexperienced reps? Are they green? What are you providing them with? Resources, coaching, mentoring, training. All of that goes into figuring out the attrition. The attrition is really kind of the hardest part here. So then down here you'd have your, total rep formula, which is basically going to say that it's going to equal, the number of new reps minus the attrition here. So we'd have, this equals the number of reps that you already had plus the new ones minus the attrition. And, now you would spread that out. And so, of course, with with no attrition, you're going to build a team pretty fast. Obviously, that's not realistic because you're going to have attrition here. Then you would go down and say the submissions per rep. So let's say that there are going to be, 4 submissions per month per rep. And then you would actually make the submissions a formula that says, the submissions actually equals the number of reps times the submissions per rep. Okay, so again, we're not really going to do that part for this, but I just wanted to show you that's what kind of we use to figure out what the submissions are actually going to be, because it's really important when you're making a projection so that if you miss the projection, you know why you missed it exactly. And in this case, it would really come down to recruiting and activation. So it may end up that you recruited as many as you thought, but you lost a lot more, and that would tell you that you're losing people, so you need to provide more resources to them, better training, better onboarding process. Or maybe you're recruiting them, they're staying, but they're only doing 1.7 deals a month instead of 4. Well, now okay, it's something about after the fact. Maybe they're selling from multiple processors and we need to get them all to us or whatever it is. So that will help you. So anyway, you have your submissions, okay? The next number that's going to matter is going to be attrition for the merchant. So this is going to be merchant attrition. And we're going to represent this with a formula just to make it easy. Let's say it's 20% a year. That's not a crazy number. It's a little high, but not too crazy. And then what we're going to do is we have a 20% attrition. And so then this is going to be, actually we're going to rename this and say total merchants. All right, and we're going to say with attrition. And let me space it out a little bit more there. And so what this basically is going to do is we have our attrition at 20%. So the first cell is going to say it's going to equal 40. The next one, though, is going to say it equals this number here. So the merchants that you had, 40, you started the month with 40 merchants, plus the new ones that you sold here, okay? And then we're going to say minus, and then in parentheses here, we're going to put the merchants that you started the month with times this attrition amount right here, divided by 12. So this is a very simplified way to do it. There's another way that I've done it before if you want to be really, really super accurate. But what this formula basically does is it says, okay, let's look at the total amount of merchants that you had starting the month, and let's assume that you're going to lose 20% a year. Let's divide that 20% by 12, so you're going to lose that percentage of those total merchant accounts every month, and we're going to subtract that from the total amount. Then we'd want to, you can see at 79.3333, we would want to format this, and we would want to make it a number with no decimals, because you can't have 0.5 accounts. And then we're going to just take this and just copy this one all the way over. And you can see that at 48 months, if you do 40 accounts with 20% attrition, you're going to have 1,329 accounts. Okay? So that tells you how many total merchant accounts you're going to have. And again, we've got our two assumptions here. I'm going to go ahead and actually make the assumptions a color. Let's make it this color here so we can see what our assumptions are. All right. Let's go ahead and add a little space in here so we can see a little better. All right. Next thing we're going to look at, so you have your first two major assumptions is the number of submissions a month, which you're really going to want to determine based on your recruiting, or if you're doing online marketing, how many leads are you going to buy, what's your closing rate going to be. So there's other variables that go into your submissions, but I would need to know the specific business model to really make that. So we have the submissions. The next one we have is the attrition. Again, there's a lot of things that go into that. Historical averages are the best way to look at that, but here we set it at 20%. The next major assumption that really matters is going to be the gross margin. So what is the gross margin? So I'm going to put this in here at $80, all right? Now, an $80 gross margin, what that actually means is that means the total profitability of the account. So when you look at all of the fees that are collected, so on the merchant statement, you have a certain amount of fees that are going out to the merchant, okay? If you take those fees and you subtract the interchange costs, the dues and assessments, the other pass-through costs, then you subtract the Schedule A cost that you have. You usually have a Schedule A cost. You're going to have a gross margin. Now, the gross margin, that's not your residual. That's just the total profit when you look at the total revenue or the total fees, and you subtract away the total costs. So when you do that, I'm putting here 80. This number, again, varies a lot depending on what types of merchants you're going after. Is it brick and mortar? Is it high risk? Is it whatever? And so $80, we'll go ahead and use 70 here just to make it a little bit more conservative. So we have our gross margin. So we want to see what our total gross margin is. Now, the total gross margin, just like the residual, is usually going to be behind by a couple months. So if you want to get something that is really, really accurate, the way you want to do this is this first one is going to be equals this here, the 40 accounts from last month, times the gross margin, and I'm using these dollar signs. If you don't know Excel, I'm using the dollar signs to say we want it to stick to that cell right there. And then we're going to go times 0.5. So what that means is that we're assuming you're going to get half of the residuals from the sales that were actually approved last month. Oh, I'm sorry. Actually, I need to move that. Well, what am I doing here? Hold on one second. That actually needs to move one over. It's going to usually be a full 2-month delay here. So we'll put that right there. And then there's that and that and that. Okay, good. All right. Okay, so now we're going back 2 months and saying the ones that were approved 2 months ago, we're assuming they probably processed for half of that month, so you got half of the residuals, okay? Now, when we take that over here to the next square, what we're going to do here, and again, it does that because it's just not big enough there. One of the things I want to do actually is I'm going to take this whole line right here, and we're going to go currency, and then we want to go format cells, and we're going to give it 0 decimal places. That way it'll fit a little better in there. So with this one, we're going to take that right there. So it's basically saying, of the, total merchant accounts you had here, we're going to move this up for a second here. And we're going to say that we believe this one here, so it's going to be the sales that were made there are going to be at 0.5%, all right? But then it's going to say plus, so we're going to put that in parentheses, plus the total accounts before that times the gross margin. So in other words, all this formula does, it looks really complicated, but what it really does is it takes the half of the residuals that you made from 2 months ago. We assume that those accounts are going to process for half the month, and the ones from 3 months ago, we assume they're going to process for the whole month. And so there's your number. And so it's really pretty simple. Only other thing we need to change here is when we do B6, we want to make sure we put those dollar signs so it just locks it in there. All right, so now we can actually just grab this formula and just drag it all the way over. Okay, and we can see that's pretty nice. After 48 months of making 40 deals a month, you're at $90,542 a month in gross margin. All right, next thing we're going to look at here is we're now going to make a new section called income. So we now have kind of our main assumptions up here. These are the 3 assumptions that really matter, and these are the 3 assumptions you got to really think about when you're building a processor. How many submissions are you going to do a month? What's your attrition going to be, which is going to tell you your total merchant accounts in the portfolio? And number 3, what is your gross margin? And that's going to really give you all the information that you need to figure all of your income and expenses out. So let's start with income real quick. We'll do income, expenses, and then we're done. So on the income side, it's really pretty simple. The first type of income you're going to have, we'll put in here upfront bonus. All right, so let's say you've got an upfront bonus of $200. Okay, and let me just do this. And again, just kind of formatting it real quick here. So $200 bonus. And so all we have to do for this formula is really simple. Whoops. We're just going to go equals this with our dollar signs because we want it to always be B9 no matter which cell we're on, times the number of sales made. So you made 40 sales, you got $200 a sale, you made $8,000 that month in upfront bonus money. Drag that all the way over. And you can see you're going to make $8,000 every single month. Now again, notice the way that I'm building the spreadsheet though, it's really nice because that way you can go up here and change this to 30 and that changes everything. 30 deals a month or 40 is going to change it back. So just allows us to play around with these and see kind of how it's going to play out for us. Okay, the next income we're going to have is going to be residual income. The assumption here is going to be your residual split. So let's say you're getting a 35% split on this. And so now we're going to take the residual here. So we go over to where we have some gross margin and we say that it's going to equal the this number here, the gross margin, times whatever your residual split is. And so we're going to put the dollar signs here so it'll always stay B10. So in other words, of this $1,400 in total profit, you got 35%, which is $490. And so we drag that all the way over. All right. So you can see down here with what we put in at 48 months down the road, you're bringing in $31,000 a month in residual income. And those are the only two types of income I'm going to put in there right now. There are many other types of income you have to look at if you're going to be recruiting a team. You've got breakage income. You have issues with things like clawbacks or chargebacks on upfront bonuses. Maybe you're selling leases. That's something else that you could have. And so we could even put something like that in here. We'll put in a lease income on here. We'll call it lease income. So we could also have that assumption, and we could put it at, so in other words, what's your average lease funding amount? So let's say it's $425 on average. And again, let's go ahead and format this real quick here. And so it's 425, and so now we're going to go equals the total number of sales times the total lease income. And again, really you'd probably want to have another row. Like usually what I do when I'm actually making a real projection is we'll have another row here where I can put other stuff. So I have 425, but actually maybe only, and I'll go ahead and do this here actually. Let's say that 30% of the deals are getting a lease. So let's say 30% of your deals are getting a lease. So we would actually take this number times 30%. And again, there's a lot of things like this, nuances that you want to make sure you really understand if you're making a projection like this, which is why a lot of people end up getting somebody like me to help them put it together. So, 30% of your sales are taking a lease. You're getting $425 on top of the normal bonus on those, whatever. So here's your income. Then we're going to have our total income. All right, and I'm going to make that bold and over. And then all we have to do for the total income is basically just say it equals the sum of these three lines, and then we're just going to drag that over. All right, so we now have our total income projected out for 48 months. Now let's look at our expenses, and then we can see our profits, and then we'll be done. And you'll have a much better understanding of how this industry actually works. So in our expenses, what we have here is we have bonus payout. So let's say you have a team of green reps, and you're paying them, I don't know, let's say you're paying them $150 a deal. Okay, and so we're going to go format cells. Oops, hold on one second here. Let's make it currency. So we have a $150 bonus payout. So if we go to month one, we're going to go equals the total sales times the bonus payout. So this is the amount you're paying to your sub-agents or to your referral partners or whatever. So how much money are you paying out up front? And we're going to go ahead and drag that over. Okay, and then you have your bonus payout. The next thing you're going to have here is you're going to have your residual payout. So this is where we're going to put in a percentage that we are, paying out to our sub-agents. And there's a couple different ways to look at this. You can put it as a percentage of the gross margin. In this case, I'm going to say we're paying out 50% of what we get to the sub-agents. And so we're going to put this at 50% of what we get. So we're going to make a formula that says equals our total residual, which over here starts to pile up, times this percentage right here. Use some dollar signs here. All right, and now if I drag that over, we can see that on month 48 we had $31,000 in residual income. We paid out 15. All right, so let's go back over here, and you know what? Let's go like this. So let's just format this here. All right, so we have that expense in there, and then the last one we're going to look at is going to be the equipment cost. And on this one, whoops, I made that all a. Hold on one second, everybody. Oops, let's go back to making that a percentage. There we go. So the equipment cost here, we're going to say, okay, let's assume in this case that our processor is providing a free terminal as part of this deal, except if we lease it. If we lease it, then we have to get our own terminal. So that means that 30% of the time we have to spend, I don't know, $225 on the terminal, okay? So when we do a lease, we have to spend $225 to buy the terminal. So we're going to go equals the total number of sales times the equipment cost, which we need to put our dollar signs in here to go like that, okay, times 30%. Now, really, I could have put that order differently, but it's going to do the same thing. But what this formula is going to do is say, of the 40 sales, 30% of them got a lease, and we need to buy a terminal with for those 30%, which is going to be $225 a piece. So that's going to cost us $2,700. So if you look at your lease income of $5,100 minus $2,700 down here, that'll tell you what you're going to make on your leases. Okay, so we're going to go here. I'm going to make it currency. Format cells, going to go just 0 decimal points here. All right, so there's our equipment cost. Now, there are obviously a lot of other costs that we could, put into this model, but this is pretty much the basics here. And so we're going to go ahead and put total expenses. We're going to make that bold and over here. And then we're going to go equals the sum of these three right here. Paste this over. All right, and now we can put the number that really matters, which is, we'll say this is gross profit. Okay, and then I'm going to show you a couple things about this that I think will really be interesting to you. So we'll put our gross profit in here, which is really, really simple. That's just our total income minus our total expenses. So here's the moment of truth. So what this will tell us is that after 48 months, with submitting 40 deals a month, with 20% attrition, with a $70 gross margin, a $200 upfront bonus, a 35% residual split, $425 lease on 30% of the deals, where you're getting $425 in funding, $150 payout to your subagents for every deal that they make. And again, you could even put a percentage here and say maybe only 50% of the deals are going to be made by your subagents. So we could do that. 50% payout, so you're paying your subagents 50% of what you're getting, and a $225 equipment cost when you sell a lease. That means that your profit the first month would be $4,400. Your profit on month 48 would be $20,245. So one thing that's interesting to note is kind of the rate of growth. It does slow over time, because what happens when you're attriting at 20% a year, it's very hard to get above a certain level because you're losing a lot of accounts every year. And so that the sales you're making are barely compensating for the attrition. I'll show you some interesting things. If you take this down to 15% attrition, we were at, I think, 20,000 something. Now we're at 21.5, so you can kind of see some of the differences that makes. Makes a big difference over time. And so this shows you our gross profit. Now I want to show you a couple of the other models in the industry just so you can have a better idea of it. One of the models that you could do here is you could go and say my upfront bonus is going to be 0. Okay, and I'm still going to pay out that $150, but because it's at 0, maybe you're able to get a 60% split. So the idea is trading off your upfront bonus for a higher residual split. Now you can see the problem with that is that you're going to lose a little bit of money initially because you're paying the upfront bonus money out without getting any, any money from the processor. But you'll see that it makes a huge difference when you get to month 20, and you're at $23,563. Now again, a lot of it's because the attrition is so high, but you can kind of see the difference that makes because of that higher residual split, and it makes an even bigger difference when you get to, like, say, month 60 here. Watch this. If we copy this and just go over, let's paste it over. All right, so let's get to month 60. And at month 60, we're now at $27,884. Okay, versus if we were at a $200 upfront bonus and 35%, instead of 27, we're at 22. So it's a $5,000 a month difference. So, that makes a really big difference. Then it really just comes down to these other things. What kind of agent program do you want to have? Do you want to pay out a higher, percentage? Do you want to pay out more money? Whatever. What about if you said, okay, we're not going to lease any terminals. So you change that to 0 and change this to 0. Okay. Now if we go back to 0 upfront bonus and 60% residual, with no leases, well, you can see you're going to lose a good bit of money here. And we could even figure out exactly how much if we just went and said equals this plus this. And then this one is equals this plus this. And so we can kind of see a rolling total here where, we can see that for you to run this particular model, you're going to need to have $33,902 in the bank to do this. So projections like this are really important. You might say, well, I don't want to get an upfront bonus from the processor because I want a bigger split. Okay, that's fine. Do you have $33,000? Or check this out. This will be really interesting for you. Watch this. We're going to spread this out a little bit more here. We take it all the way over. You can see that over the course of 60 months, you would have made $700,000 in this plan. But here's the interesting thing. Watch what happens if we take our bonus payout to 200 instead of 150, and if we change our submissions to 100 a month. Well, now all of a sudden, you're going to be losing a lot more money. And so, you're going to be, you need to have $140,000 in the bank to pull this model off. And there's a lot of other assumptions that we didn't even put in there. So my whole point of this episode today is I really just kind of wanted to show you the industry. This is how it really works when you build a processor. These are the core assumptions that you need to understand. There are obviously a ton of trade-offs. If I was building a real projection for you, when we did gross margin, we would put things in there like, your Schedule A per item cost, your other things like that, and figure out what types of merchants you're going after. And so there's literally like a whole tab that we could create that's for recruiting that would feed into the submissions. Then there's a whole tab we could use for the gross margin that would feed into the gross margin amount. Then there's another tab for income in terms of how you're going to set up your program. Is there going to be clawbacks? Is there going to be breakage where if somebody's inactive, you take back the residuals? So there's a whole big thing here that you've got to understand the financial picture of. But this gives you a general idea of how to build a projection for a credit card processing company, a financial projection, and this is really how the industry works. So hopefully this has answered some of your questions. If it's created some questions, shoot me an email, james@ccsalespro.com, james@ccsalespro.com. I'd be more than happy to talk with you and help you understand the industry a little bit better and even set up a consulting, whether it's an in-person visit or a remote session to talk to you more about the business and help you understand what goals you want to set and how you want to go after it next, because there are hundreds of variations on this model, whether it's a direct rep model, online marketing, even if it is a direct rep model, are you going after green reps, experienced, inexperienced, industry professionals, small offices, are you going to lease terminals or provide them for free? And, there's just a million different ways to structure this, and we could go over all that with some consulting. So just wanted to show you this. Hopefully this was insightful to you and help some of you understand the industry a little better. My name is James Shepard. Hope you have a tremendous day today.